I truly believe that most booms and busts are caused by the Fed. That is, I think monetary policy is what causes most of these booms and busts. It is mistakes with regard to interest rates, for example, that cause these problems. Now, there will be booms and busts, but they are much more likely to be localized, and they're much more likely to be able to be absorbed by the private sector without the kind of systemic risk that we have today in the system. I think what we're seeing today in terms of the systemic risk that exists out there is a phenomena of centralized power. And centralized power is a phenomena of government. I don't think you get this kind of centralized power in a private economy. So, but yes, let it rip. But I don't think that ripping is that big of a deal. I don't think it's that big. I don't think it's that substantial. I think private markets know how to handle these things and develop mechanisms. And this is the other thing. Let's say Michael is right, and there's too much power, and this is going to create some real economic distortions, right? Then markets are very good at developing new institutions or new types of products to deal with those kind of situations. So I truly believe that the best way to deal with problems is to unleash human ingenuity. And what happens when you create a Federal Reserve, you create a centralized entity that becomes calcified. And it doesn't just become calcified, it's by its nature, it becomes calcified because it faces no competition, it faces no forces that force it, in a sense, to stay on its toes and to innovate and be and constantly. The marketplace is constantly innovating, constantly changing. And as a consequence, we'll find solutions to these problems that are beyond what a central planner can imagine, and they'll constantly have to change and constantly have to innovate as markets change.
The story that we were just told about the global financial crisis is illustrative of the challenges that we face in this approach. So the core issue that existed within the global financial crisis, I agree, regulation played a significant role. I do not think that Ben Bernanke telling people to go get variable rate mortgages played any significant role whatsoever. And in fact, the irony is that because the Fed cut interest rates so rapidly, we didn't actually see distress emerge from rising interest rates and variable rate mortgages. What actually caused the distress was first payment defaults and fraud within the privately rated mortgage system. Right, so mortgages were obtained that were privately rated, that were graded at a certain level, and because the documents they were produced with were fraudulent in nature, putbacks existed that then created off-balance sheet liabilities that came back onto the bank's balance sheets. And as a result of the dynamic of that, we saw a wave and cascade of defaults throughout the system. So everything that Yaron just mentioned fell apart. Now, did the Fed play a role in articulating certain levels of reserves that needed to be held against certain levels of ratings, et cetera, or the ability to get things off balance sheet? Of course it did, but that's going to be true in any setting. And any private system is subject to the exact same corruption that Yaron is attributing to the Fed. I can take a private rating agency middle manager out for steak dinners and they can upgrade the ratings on my bonds. Who becomes liable for that? Who goes to jail on that? It's too small of a crime to really prosecute, right? Does the CEO of the ratings agency go to jail? No, of course not. The core issue that we're talking about is, yes, systems become corrupted. Yes, systems become too large. Does that mean that we shouldn't attempt to regulate them, that we shouldn't attempt to solve those problems? The answer, of course, is no. We should do a better job of it. What Yaron and I both agree on, and I've read some of his stuff, I've watched some of his stuff before, is that we should do a better job of electing and appointing regulators and leaders, whether those are politicians or regulators placed in roles that enforce the responsibility of the individual and minimize the role of the state in this process. But we can't ignore the role of the state. We can't pretend it doesn't exist.
The problem is that whenever you give regulators regulatory power, you're going to create corruption and you can create systemic risk. I mean, I'm glad you brought up rating agencies because, I mean, rating agencies are so perfect as an illustration of exactly this example. There were only three, or at least in 2008, there were only three rating agencies. There were only three because only three were certified by the government, by the SEC. These were rating agencies that had failed repeatedly. I remember Orange County going bankrupt. just weeks after it had a AAA rating from the rating agencies. I remember Enron going bankrupt just a couple of months after it got AAA ratings from the rating agencies. Why didn't those rating agencies suffer any consequences from being so bad at what they did? Why is that the guy who you took out to dinner and who raised the rating of your bond and then something bad happened, why are there no economic consequences to him? Because these are rating agencies protected by government monopoly power. It's not a monopoly, it's an oligopoly because there are three of them. Now, why does anybody pay attention to those ratings? This is what happens when you get regulations. They build upon one the other. It's because ERISA forces institutional investors only to invest in rated securities. So insurance companies, pension plans, and many others have to use the rating agencies. They have no choice. Hedge funds don't pay any attention to the ratings of rating agencies. They just don't, because they know it's completely corrupt, right? Because it's a government entity. So the problem with any attempt, even by the best people, even if you put saints in positions of regulatory power, they will be corrupted by the system because they are now wielding force. And this is going back to the difference between us in terms of violence versus voluntary exchange. As soon as you give people the power to wield force, to wield coercion, that is a corrupting influence. And of course, you put them in a position to regulate markets where they have no clue how to regulate. The regulators are not going to be smarter than the bankers they try to regulate. They're always going to be captured if there's just no other alternative. There is no other way. There's no other country where they're not captured. The best way is to let markets self-regulate. That is, to let markets develop rating agencies, because there are rating agencies outside of the banking system that are not provided government monopoly that do a pretty good job. And I think you can create a market in rating agencies, a real market in rating agencies. I think, on a different topic, I think we should get rid of the FDA and privatize that function. And privatize that function means rating agencies, agencies that test drugs and give them ratings to doctors. That's the proper way to separate coercion and force from markets and leave these regulatory functions to voluntary exchange. I think you get far superior outcomes. And you don't get the kind of, you get corruption. You always have corruption. Let the government focus on putting corrupt people in jail. If that's all it did, if the SEC, instead of reading my 13 Ds and 13 Gs, if the SEC just went after the Bernie Madoffs, then it would be a part of the police force going after corrupt people. But we know that's not what it does. As soon as you create an SEC, it wants to control me. It wants to tell me what I can and cannot do. And Bernie Madoff, to hell with him, even though they knew what he was, they got reports on what he was doing, they never caught him, and they were too busy. They were too busy, following up on Michael and my trading to worry about a real fraudster.
If you enjoyed this video clip, click here to watch another one you should like.